Welcome to the latest IFSL Brunston Funds update. It's been very interesting investment markets of late, and I'm very pleased to say that this morning we have with us Frank Atkins, who is one of the investment fund managers at Brooks Macdonald, and indeed one of the key individuals who looks after the Brunston Asset Management investment funds. Welcome, Frank.
Thank you, Brian. It's nice to be here.
Nice to have you here again. Frank, we have a number of questions that we get from our clients these days, and one of the top ones which we get lately is of course to do with North Korea and the saber rattling which has taken place there. I wonder if you could sort of just cover some points as to how it affects investment markets.
Yes, it's undoubtedly one of the largest issues that is facing markets at present. The big problem really is that there doesn't seem to be a military solution. Any military action in the Korean Peninsula would cause untold devastation to South Korea, which is an advanced first world economy, and this would obviously send markets into a tailspin. So I think what we'll need to see really is China using the leverage that it has with the regime in North Korea to bring about a peaceful solution. What was interesting though was really the reaction of markets during August while this was happening. It was actually the markets in Asia and the emerging market economies which performed better than the Western equity markets, which you would think that would be sort of counterintuitive. You would expect that the markets that were sort of closest to where these events were happening would perform worse, but perhaps it suggests that they're coming to terms with having this issue on their borders, and that it's actually been discounted into the price. As far as we're concerned, running the investment funds for Brunston, we won't be making any changes based on what may or may not happen, simply because we can't predict either way. It's so far beyond our control. So we have to keep on picking funds and doing our asset allocation based on the sort of the economic fundamentals that are occurring within Asia and the emerging markets, and they are broadly positive at the current time.
Thank you, Frank. One of the other burning questions we constantly are asked is with regard to Europe. Of course, there's been a lot of changes here over the last few years, elections, etc. How is that affecting investment markets at the moment?
Yes, Brian, it's another very important question. There's no doubt that the political risk in Europe has reduced. After the elections that we've seen this year, at the start of 2017, we had the Dutch election where Mark Rutte, who's the Dutch Prime Minister, he retained his position. And of course, in France, a few months later, we saw Emmanuel Macron defeat Marine Le Pen in the second runoff of the French presidential election. And so the status quo has actually been maintained in Europe, and we didn't see a continuation of the so-called populist surge, which many predicted would happen after the outcome of our own European Union referendum. What is interesting though in Europe is that equity markets after the election of Emmanuel Macron were expected to rally strongly because of the relief that markets were going to show that Marine Le Pen had been defeated. But actually, as we sit here today, European markets are actually below the level that they were when Emmanuel Macron was elected in May. And the reason for this has been the increasing strength of the currency itself, the euro. And what this means is that foreign investors who perhaps were looking forward to investing in European equities for the first time in a few years in large numbers have actually now been put off again by the fact that the euro has strengthened so much, and it requires them to invest more of their own local currency in relative terms into European assets. The other large issue on the horizon is how the ECB, that's the European Central Bank, begins to unwind its huge asset purchase program. This will involve reducing the amount of bonds that it buys in the market, and also raising the interest rate. If markets react badly to this, then we could see what's called a disorderly unwinding of what's been going on in the bond market, and that could lead to a heavy sell-off in equity markets as well.
Frank, another question that we often get asked is with regard to the weakness of the pound since the Brexit vote in particular. How is that affecting investment markets and the BAM funds in particular?
Well, within the cautious fund, we don't hedge currency exposure because we think it adds an unnecessary level of risk that's not appropriate for lower risk clients. Most of the assets within that fund are denominated in sterling, and so the movement in the pound exchange rate doesn't have any impact on the performance of the fund itself. There are a proportion of assets within the cautious fund, though, that are denominated and priced in dollars, and so they benefit when the dollar rises in value against the pound, which of course, as you rightly say, it has done since the Brexit referendum. So there has been a benefit to clients in the cautious fund thanks to the pound's depreciation against the dollar. The adventurous fund is slightly different. We do hedge currency exposure there against the euro and the yen, and unfortunately that has been negative because it means that we haven't benefited from the increase in those currencies against the pound. But at the same time, most of the foreign currency exposure in the adventurous fund is in dollars, and so that has been a large benefit to the fund since the appreciation that we've seen, which has been about 20%.
Probably one of the other key questions that we get is with regard to equity markets. Some people say they've risen to all new highs, and is it sustainable? What's yours? What's your take on this?
Yeah, we think they are. We think they are sustainable, and we still favour equities over bonds, especially sovereign bonds. There is a broad-based, albeit cautious, global recovery going on. In the US, we're seeing wage rises coming through for American workers. In Europe, we're seeing unemployment coming down, especially in the peripheral regions such as Spain and Portugal. And in Japan, productivity is increasing, and that's true across Asia as a whole. So we are broadly positive that these levels can be sustained. Of course, there are risks on the horizon. We've already touched on North Korea, but there are other things to consider as well. In the US, the composition of the S&P 500, which is their main equity market, has changed a lot over the past 20 to 30 years. In the past, it was dominated by big oil companies, whereas now you see that you have companies like Amazon and Facebook, and Google, in the technology sector that dominate the index over there. And so it means that it's more diversified. There is less reliance on one particular sector, which means that if there is a downturn in the oil sector, for example, it has less of an impact overall on the index as a whole. And because the American market is such an important market, for investors in the BAM funds, they will have a large exposure to the USA. It's vital that we manage the risk there appropriately.
Thank you, Frank, and thank you for watching. The IFSR Brunston funds continue to perform well, and if you ever have any questions yourself to put to the fund managers, then please be in touch. See you next time. Thank you.